Passive investing has surged in popularity, with over 50% of U.S. equity funds now tracking indices. This strategy avoids stock picking, instead mirroring market benchmarks like the S&P 500. Studies show passive funds outperform 97% of active managers over 10-year periods. Our comparison begins with two giants, index funds and ETFs. Both offer low-cost diversification, but differ in structure, costs, and flexibility. Key factors we'll explore. Index funds are mutual funds designed to replicate specific market indices, such as the S&P 500 or NASDAQ. They trade once daily at the market's closing price, with holdings adjusted periodically to match the index. Vanguard's 500 Index Fund, VX, launched in 1976, pioneered this approach with a 0.4% expense ratio. These funds excel for long-term investors seeking set-and-forget simplicity, as they automatically rebalance to maintain index alignment. ETFs, exchange-traded funds, combine index tracking with stock-like trading. The first ETF, SPDR S&P 500, debuted in 1993 and now holds 400 B+ in assets. Unlike index funds, ETFs trade intraday at market prices, allowing limit orders and short selling. Their in-kind creation-redemption process enhances tax efficiency. Popular examples like VOO, Vanguard S&P 500 ETF, offer similar exposure to index funds, but with greater flexibility. Costs dramatically impact returns. Index funds average 0.07% expense ratios, while ETFs average 0.18%. However, ETFs avoid mutual fund sales loads and often have no brokerage commissions, e.g., Fidelity's zero-fee ETFs. Bid-ask spreads add 0.01 to 0.5% to ETF costs. For a $10,000 investment over 20 years, a 0.1% fee difference compounds to $3,000 in lost gains, making fee analysis critical. ETFs shine for traders, offering real-time pricing and advanced strategies. Investors can buy SPY at 10 a.m. or short it during market dips, options impossible with index funds, which execute orders after market close. High-volume ETFs like IVV have penny-wide spreads, but niche ETFs, e.g. RK, may suffer liquidity gaps. Index funds suit dollar-cost averaging without timing concerns. ETF's in-kind mechanism minimizes capital gains distributions. When Vanguard's total stock market ETF, VTI, rebalances, it transfers stocks directly to authorized participants, avoiding taxable sales. Index funds must sell holdings to meet redemptions, triggering taxes. In 2021, the average equity mutual fund distributed 5x more capital gains than ETFs. Tax-sensitive investors benefit from ETFs in taxable accounts. ETFs democratize access. Buy one share of VTI, 220 to own 4,000+ stocks. Index funds often require $1,000 minimums, e.g. VFIX's $3,000 initial buy. Fractional shares, offered by brokers like Schwab, further lower ETF barriers. However, some index funds, e.g. Fidelity Zero, have no minimums. Small investors should weigh accessibility against their contribution patterns. Both vehicles closely track indices, but nuances exist. Vanguard's S&P 500 ETF, VOO, had a 0.01% tracking error in 2022 versus 0.02% for its index fund. ETFs occasionally diverge due to premiums discounts to NAV. During March 2020 volatility, some ETFs traded 5% below asset value. Index funds avoid this by pricing once daily. Long-term, the difference is negligible for buy-and-hold investors. Choose index funds if you automate monthly investments, prefer simplicity, or hold tax-advantaged accounts, e.g. 401ks. ETFs suit active traders, tax-sensitive investors, or those building custom portfolios, e.g. pairing SPY with sector ETFs. Hybrid approaches work. Use index funds for core holdings, 80%, and ETFs for tactical bets, 20%. Behavioral fit matters more than marginal cost differences. For most investors, ETFs edge out index funds due to tax efficiency, flexibility, and lower minimums. However, index funds remain superior for automated investing in retirement accounts. Our recommendation: use ETFs like VTI or HB in taxable brokerage accounts and index funds like FXAX in 401ks. Both strategies beat active investing. Consistency and low costs determine success more than the vehicle itself.